Alright, then guys, Jeff here back again. So today is Thursday, and I'll be going through some news first. Then afterwards, I'll be going through the FEDS minutes. I'll be mirroring my iPad for some of the notes that I actually taken. Like actually just I actually read through it last night, but I was really tired, so I went to sleep quite early at about 3 a.m. or so. But then afterwards, just now once I was done with work, I came back. I scribbled some notes and such, did some highlighting of the things that I think that is quite important for us to actually go through. All right, but anyway, I'll just get some of the news out of the way because let's be honest, the FEDS minute is basically the most important news for the day. Quite evident throughout all the mainstream media as well. Your Wall Street Journal, Bloomberg, CNBC, Barron's, all of them think the same as well. But anyway, let's cover some news today. Right. So first up, let's talk about, okay, I'll leave this for the last. Let's start with the US allies to release close to 60 million barrels of oil from reserve. Okay, so this is all the countries that are allied with the US, be it all the European countries, your Japan, Australia, Mexico, all of them who are partnered up with US, they're going to be coming out with barrels of oils, coming up to about 60 million barrels of oil from the reserve. 30 million of that would be from US. So US actually will be getting out 180 million barrels of oil for the whole period of 6 months. Right now, they're coming out with another additional 30 million barrels. So US is basically coming out with their whole reserve about 210 million barrels or so. So yeah, over here you can see that, okay, let me just, yeah, okay, so the 31 member nations of the IEA included your US, most of Europe, Australia, Japan, Mexico, others, planning to announce a new reserve release totaling 120 million barrels. But of course, they're not going to hit 120 million. But yeah, even Washington have already announced the release of the 180 million barrels. So that leaves around 60 million barrels of additional oil that will hit the market because of the IEA decision. So what does it actually entail for the market? Be it for people who are into oil stocks, energy stocks, gas stocks, or whatever it is, commodities in general. Do understand that this would most likely be tanking oil prices a little bit, but do understand that oil prices, I do not see them suddenly dropping by a lot either, because it's true that we might be, hearing millions of barrels of oil, but US alone, they use up about 30 million barrels of oil a day. So it's not really that much. Okay, surprisingly, you have to put in the consideration for like vehicles in general, your factories and such. A lot of people, a lot of resources actually use up oil. So it's not really that much at the end of the day. Okay, so all right, next up, Google bans app with hidden data harvesting software. Okay, so I'm not really sure if this is a good thing or a bad thing. I'm not gonna lie, even though Google is not, Google is not really doing superbly well. I'm not gonna lie. Google yanked dozens of apps from its Google Play Store after determining that they include a software element that surreptitiously harvests data. The Panamanian company that wrote the code measurement system is linked through the corporate records and web registration to a Virginia defense contractor that does cyber intelligence, network defense, and intelligence intercept work for U.S. national security agencies. All right, let's actually get down to, okay, this saga continues to underscore the importance of not accepting candy from stranger. The two men who also co-founded blah 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 app sensor, okay, blah blah blah. The FTC investigation are non-public. We cannot comment on whether we are investigating a particular matter. All right, so I think that they're just basically talking about the companies that are helping Google do this. I don't think that this is something that's going to be that troublesome for Google. If anything, it's a good thing for Google, because what is happening for Google on this side, it simply means that Google is actually stepping out on their cyber defense and such. So I do think that that's going to be helping Google to be on a better position moving forward. So I think that's a good thing. All right. Let's move on. The next one, which would be Shell, wants of up to $5 billion hit from Russia's exit. The first quarter charges follow oil major decision to cut Russia's tie in response to the Ukraine invasion. So Shell said it expects to book accounting charges of up to $5 billion in the first quarter related to its decision to exit its Russian operation, including joint venture with energy giant Gazprom, in the wake of Russia's invasion of Ukraine. Shell said on February 28, which is 4 days after the invasion started, it would end its involvement in financing the Nord Stream 2 natural gas pipeline project, which is kind of funny because Shell, after they said that they are going to stop all involvement, they actually did buy more oil. So, Shell also said that it would exit its 27.5% stake in the major offshore gas project in Russia, Far East, that is 50% owned by Gazprom. It supplies around 4% of the world's liquefied natural gas market. The company said at the time that the value of its non-current asset tied to its Russian venture was about $3 billion. Let's see. The range also encompassed Shell's decision announced March 8 to stop all spot purchases of Russian crude and phase out its trading and other operations tied to Russia. The company said at the time it had around $400 million in assets tied to those activities. Shell's Russia assets were held as non-current, referring to long-term investment not readily converted to cash. Shell prices is down right now. We don't really care. Quite interesting for us to really see that, for the $5 billion hit from the Russia exit, to think that oil is still so relevant, I guess. But I think that doesn't really come as a surprise for a lot of people, because I do think that a lot of people do think that oil is still quite relevant in our current economy and such. All right, but anyway, that's all that we have. For the last news is basically about the Fed signaling half percentage point increase could be warranted at coming meetings. I'll be explaining that from the for the FEDS minute from here on out. Right. So am I able to actually make this like bigger? Would this work? There it is. Okay, cool. But then I wouldn't be able to see it, but it's fine. All right, let me just go all the way to the top. I'll just use my screen as okay. Cool. All right. All right. So over here you can see for the purple highlighted ones are usually something to do with your inflation, inflationary pressure, and the highlighted in yellow are the ones that's going to be more towards the increment of interest rates or any sort of like change in the pace of, like, for example, like, going up, the slowing down of your mortgage-backed securities, and also the increasing rates hike from your 25 to 50 basis point. All right, so anyway, for the purple one, okay, you can see uncertainty associated with geopolitical development. Many central banks continue to signal intentions to move ahead with reducing policy accommodation to address elevated inflation. So I think that this is very, very important for us to really look into as well. Because let's be honest here, right now, the whole entire country, well, the whole world already understand that we are going to be having elevated inflation no matter what. Okay, when CPI hits next week on the 12th of April, everyone's gonna be kind of prepared for a bad reading. But at the same time, I do think that some people might not really understand what's going to be showing up right now. Let me check what's the consensus for the. Let me check what's the consensus for our CPI at the moment. Nice. Okay, it's not out yet. That's great. Anyway, yeah. So the consensus is still not out for the CPI, so that we cannot really know what is going to be talked about there yet. Okay, but anyway, so over here you can see that led investors to expect a more rapid removal of policy accommodation than they had previously expected. So that means that they intend, okay, well, this basically means that they are going to be tapering. But the thing is that the taper has already ended. So right now they are talking about rates increment. So when you actually remove a policy accommodation from the market, it simply means that they're going to be taking away balance sheet runoff, which is what Lyle Brainard actually came out to talk about the day before yesterday. where she was just saying that, we are going to be removing accommodation for the market. We're going to be cutting down on our balance sheet, our portfolio, the $9 trillion portfolio that I talked about yesterday. That is one of the policy accommodation that they're actually trying to remove. Okay. Moreover, futures price implied that the federal funds rate would increase around 170 basis point through year end, and about 70 basis point more than what has been priced in at the time of the January meeting. So what this means is that they are expecting around 0.7% more in terms of our interest rate hikes as compared to what was actually penned down in the January meeting. But of course, something did change for the March meeting, where we actually had our SEP, which is the summary of economic projections, and also written in the dot plots and such. So we are totally in the know of what's going to be happening anyway. All right. So over here, yeah. Okay, so they're talking about the whole market participant expected the interest on reserve balance rate and overnight reverse repo offering rate to be increased by 25 basis point at the current meeting. All right. So, in summary, basically from the, here on out, in summary for what I just talked about in this whole entire page, they're actually talking about more towards the side of things that, like, for example, people who think that inflation is not here. Well, you're wrong, because inflation is here. And they're just trying to tell you that the Feds are trying their best for them to actually start to remove accommodation to the market, because that way they can actually start to cut down on inflation. The more they accommodate to the market, the more they actually invest in the market, the more they actually put more resources to bolster the market, the less resources they have to fight inflation. That's kind of how it kind of works. Okay. So let's move on to the next one. Discussion was preceded by a staff presentation that reviewed the committee's 2017 to 2019 experience with balance sheet reduction and presented a range of possible options for reducing the Federal Reserve securities holding over time in a predictable manner. All the options feature a more rapid pace of balance sheet runoff than in the 2017 to 2019 episode. All right, so this one, they are talking about the 10-2. Okay, so for people who know about the 10-2, you kind of already understand that they are talking about how the 10-2 actually did an inversion in 2019. So this is a possible hint at a recession, or at least the fear of a recession. Okay, and for people who don't know about the 10-2, I might be making a video on the 10-2 on Saturday, so that maybe that can kind of make into a better form of content for you guys, instead of me just cramming all this new context into you guys. All right. So next up, the participants generally agreed that the monthly caps of about $60 billion for Treasury securities and about $35 billion for agency MBS mortgage-backed securities would likely be appropriate. So yeah, they are thinking about cutting down on the balance sheet again, which is a good thing, kind of. Okay, so adopted an approach to balance sheet reduction in which reserve declined relatively rapidly. Had made a substantial progress on the plan that the committee was well placed to begin the process of reducing the size of the balance sheet as early as after the conclusion of its upcoming meeting in May. So this is what we were afraid of by what Leo Brainard actually talked about the day before yesterday. But like I said before, this is not new news. It's not as if Jerome Powell did not really already tell us about all this. We already know that this is going to be happening to begin with. So I don't think that it is going to be new information. But of course, this did shock the market a little bit, because when they actually say as soon, as early as after the conclusion of his upcoming meeting in May, a lot of people think that the Feds are going to be rug pulling the market immediately after during the May FOMC, which is going to be happening on the 3rd and 4th of May. Okay. So, of course, if you are asking me, I do think that the possibility of them rug pulling us is generally 50-50. I'm not going to lie. I do think that there is a good chance that they will still continue with what they actually penned down from the previous meeting, from the March meeting, which I do think that that's a very, very high possibility. The reason why I still put it as 50-50 is because a lot of participants do think that we should be getting a 50 basis point increment. However, At the same time, I think that Jerome Powell is still going to be remaining dovish for now. Of course, we do not have any sort of comments from Jerome Powell yet. I do think that we will have one meeting with Jerome Powell before the FOMC. So hopefully, Jerome Powell actually said something, actually give us some form of a direction in that meeting. But otherwise, we will most likely be seeing most of it on the 4th of May, when Jerome Powell basically come and talk to the entire Congress about. Not to Congress. He will be doing an interview, a Q&A with all the reporters about how the FOMC summary is going to go. So yeah, I do think that if in May we were to get a 25 basis point increment, which is still very, very possible as well, I think that this is going to be very, very good for the market, because if there's so many participants thinking that we should go to a 50 basis point increment, we have to treat it like in terms of the hawkish Fed and the dovish Fed. A lot of them wanting a 50 basis point increment are the hawkish Feds. And personally speaking, I do hope that the Federal Reserve would be a little bit more hawkish, because at the end of the day, do understand that we want to get rid of inflation as soon as we can. And the longer the Federal Reserve remain dovish, the longer the time it will take for us to actually get rid of inflation. Just treat it that way, okay? But of course, at the same time, there is some form of a balance for the Federal Reserve to actually get, because if they were to be hawkish way too fast, recession. And if they were to be dovish for way too long, recession. So I do think that they really have a very, very difficult job for them to actually get over here. All right, the US real domestic GDP was increasing in the first quarter at a pace that was slower than the rapid gain posted in the fourth quarter of 2021. So this is talking about the SCP. When we are in December FOMC, we were expecting the GDP to be going up way more. But then, yeah, clearly the invasion did not really help with the whole situation. All right, consumer price increase to continue to rise rapidly. The PCE inflation was 6.1% over the 12 months. Okay, so this is talking about the PCE, which is the personal consumption expenditure, okay, which exclude changes in consumer energy prices and many consumer food prices. So of course, this is going to be excluding a huge bulk of what is happening in Ukraine, okay? And for that part, it is now 5.2% over the same period of time. So this is gonna be telling us a very, very important thing, which is very, very integral. Okay, so if we actually take into consideration that Ukraine, Russia invasion did not happen. Okay, Russia-Ukraine invasion did not happen. Inflation at the moment is still going to be at 5.2%. That's why I thought that the PCE was actually quite interesting for us to look at, because if we actually take the normal PCE instead of the core PCE, the total PCE was 6.1% year over year. Okay, and for the core PCE, which exclude your energy prices and food prices, what do we have a huge problem of with the whole Russian-Ukraine? Oil prices, energy prices, okay, wheat, food. Okay, and we have nickel, which builds battery, energy prices. So I do think that it's quite integral for us to actually see that it is still the core PCE is still going to be 5.2%, which is very, very important for us to really look at it. Because if it's still at 5.2%, it simply means that this Russian-Ukraine situation is not really that good of an excuse for, we are having a crazy, insane high inflation, because that's not the case. Okay, without this whole invasion, we're still going through a hyper-inflated economy, and that's why that's the concern that a lot of people is having. Okay, the 12-month change in the consumer price index was 7.9%. This is the CPI that we always look at, which I like to use a lot more, and the core CPI inflation was 6.4% over the same period. Okay. Now let's move on to the next one, which is the Russian invasion of Ukraine, however, constitute another negative shock to the global economy by pushing up commodity prices further, hurting global risk sentiment and excavating supply bottlenecks. I think that's something that we already understand and we already know of. Recovering global demand, rising retail energy and food prices, ongoing strains on global supply chain. It's nice that we actually see that the FOMC, the Federal Reserve is actually also pointing out that these are the things that is actually happening. Investors interpreted incoming economic data and Federal Reserve communication as implying a more rapid removal of monetary policy accommodation than they had previously expected. All right, so this is also quite a big one. Okay, so the Federal Reserve are implying that there will be a more rapid removal of monetary policy accommodation that they have previously expected, aka back in January. They were expecting that we might not be going through a balance sheet runoff that quickly, or not at that level. But right now, they are going to most likely be doing it way quicker, simply because they have to really combat this inflation ASAP. All right. Equity prices increased early in the period because of the stronger than anticipated corporate earnings and economic data releases, but they retraced these gains as investor risk sentiment deteriorated following the Ukraine invasion. All right, next up, despite downward pressure from the geopolitical events, the AFE sovereign yield increased notably on higher than expected inflation reading and central bank communications that were perceived as less accommodative than expected. So yeah, a little bit troublesome, but nothing too crazy. Okay, this one is not so important. Okay, this is the important one. Okay, I'm going through all the important ones instead. Okay, so the staff near-term projection for PC price inflation was revised up considerably relative to January. Okay, broad-based level of domestic inflation, import price inflation, wage growth that has been observed. Okay, the staff expectation that the upward pressure on inflation from supply and demand imbalance would last longer than previously assumed. Okay, so let's unpack this a little bit. Okay, the staff near-term projection for PCE price inflation was revised up considerably relative to January. So, of course, this is the FEDS minute for what happened in March. Okay, so this is what has already happened in March. It was penned down in March. Okay, so we have to take this with a grain of salt that they still do not know what is actually happening with the whole Russia-Ukraine situation at the moment. They do not know what has actually transpired in the past month. Okay, the staff near-term projection for the PC price inflation was revised up considerably relative to January. Of course, this is also due to the sudden spike up in fear, the fear catalyst that we have during the invasion. Because the invasion did happen on the 24th of February, which is 4 days later, that was the end of the month. And then a few days later, that was the start of the FOMC. So yeah, I can totally see why. All right, broad-based levels of domestic inflation, import price inflation, and wage growth that has been observed. So these have all been issues that have been talked about in the Congress for the past month or so. I do think that the Federal Reserve is trying their best to really be combating onto this situations and such. But I do think that this is not so important for now. All right, next up, which would be the upward pressure on inflation from supply and demand imbalance would last longer than previously assumed. So the things that we expected the imbalance for the supply and demand to actually last 1 to almost 2 years. So back in 2021, around November, December-ish. So I like to still consider it 2021. The Federal Reserve expected supply chain demand, the supply and demand imbalance to actually go all the way out to 2023, and even possibly to 2024. So what they're actually saying here, right now, the upwards pressure on inflation from supply and demand imbalance will last longer than previously assumed. I would like to think that what they actually mean over here is saying that they are expecting this whole Russian-Ukraine situation to be an occupation. It's not going to be an invasion. It's not going to be a quick war. Okay, it's going to be an occupation. And I think that the Federal Reserve do already recognize the fact that is going to be the case. And because of that, they think that because of the whole situation, how they think it will transpire in their minds, they are going to be putting the imbalance for the supply and demand way further out in the future, even possibly to 2025 or so, because that's how bad supply chain bottlenecks is going to be happening if an occupation is going to be happening, especially with Russia and Ukraine. The few key imports for your energy sources and your food sources and such. So those are the worries and the concerns of the Federal Reserve. Okay. I thought that this was very, very interesting. All right, the next one that was, yeah, okay. So, okay, this is a little bit big. Okay, so adding to the uncertainty around the outlook for economic activity and inflation, further excavating supply chain disruption, putting additional upward pressure on inflation, boosting the price for energy, food, and other key commodities. Okay, inflation expectation to become unanchored was seen as another upside risk for inflation projection. All right, so inflation expectation to become unanchored. So it simply means that we are now unable to really properly have a good projection for inflation, because right now, if the Federal Reserve or the street consensus were to actually plot it at about 9% for inflation, that can very well be the case. And that's why the market probably actually read to this point and the market kind of crashed a little bit. That was where I was at as well. Then afterwards, of course, like I said before, these are not things that are completely out of these are not things that we have not heard about, or these are not things that we have not heard from Jerome Powell himself either. Okay, these are things that has already been time after time being informed to us over and over again. So I do think that the market basically started to bolster themselves a little bit and think that, it's all right. At the end of the day, I don't think that it's going to be that big of an issue. Inflation is a big risk, but they think that the Federal Reserve are going to settle the inflationary pressures. Okay, so cool, interesting. All right, many participants indicated that their business contacts continued to report substantial increases in wages and input prices that were being passed through into higher prices to their customers without any significant decrease in demand. This one is a complete Elizabeth Warren style situation. All right, so let me just go back to this again. Many participants indicated that their business contacts continue to report substantial increases in wage and input prices that were being passed through into higher prices to their customers without any increase in high demand. Okay, so business contacts, be it all the business people in America and such. Okay, you could have an increase in your wages by like 5% because of inflation. You can do it by 10%, inflation, whatever it is. Okay, input prices in general, what the manufacturer comes down to the next business, kind of like a business to business communication. Okay, the manufacturer is gonna be bringing down the prices to us. For example, I am a renovation contractor. Okay, so my manufacturer, let's say an aluminum manufacturer, were to give me the pricing for aluminum, let's just say at $10 at previously, before anything happened, let's say pre-pandemic it was $10. Okay, right now, because of all this happening, he can just tell me that it's now $15. And because of it being at $15, usually I charge my client at about $13 or so. Right now, I'm gonna be like, okay, since I'm getting this at $15 now, I'm sorry to my clients that this is now gonna be $18. Would you guys be okay with that? And even though the demand did not really change, I am still going to be charging you higher. And for the end consumer, for example, the end consumer is not going to have much of a choice. The end consumer is going to say, okay, fine, $18 is fine. Okay, he or she is going to pay me $18, but he or she is going to go back to her own workplace or his workplace, and they're going to realize that they are not going to be getting, like, for example, a 8%, 80% increment on their wages, or a 10%, 20% increment on their wages, because a lot of time the job is most likely going to be giving you a price increment of like 2%, 5%. Okay, if they're generous, 10%. If you're changing job, 20%. But prices, okay, they're actually being brought forth from other sites, which is basically the commodities manufacturers and such. They're bringing down the price and they're increasing it by 50%. They're increasing it by 30%, and those are numbers that you cannot really get in terms of wage growth. So that's something that's going to be very, very interesting for us to really look into. Okay, I don't want this to go too long. I realize that it's already almost 30 minutes and so. All right, I think, yeah, okay, this is the last one actually. So elevated inflation and inflation expectation could become entrenched if the public began to question the committee's resolve to adjust the stance of a policy as appropriate to achieve the committee's 2% longer run objective for inflation. Expediting the removal of a policy accommodation would reduce this risk while also leaving the committee well positioned to adjust the stance of a policy if geopolitical and other developments led to a more rapid dissipation of demand pressure than expected. All right, so over here, let's talk about the first one, which is the elevated inflation and inflation expectation that could become entrenched if the public began to question the committee's resolve. Okay, so they're basically saying that the Federal Reserve might not want to get rid of this inflation as fast as they can, which is why they're being so dovish. Okay, the reason why Jerome Powell is thinking about, yeah, sure, we can pen down like 8 rate hikes, but we're only going to be penning down 8 rate hikes with 25 basis point increment. Whereas people, like for example, countries who are going through hyperinflationary pressure, they might just be like, all right, you know what, let's do a 100 basis point increment tomorrow. And then afterwards, then we'll just pen down another 5 more 25 basis point increment, that sort of thing. That's going to be very, very hawkish. Okay, that's going to be very hot for the market. However, if they were to do that, let's just say they were to just immediately implement something like that. Let's just say the next month, companies who actually need the money or need the resources for them to actually loan the money to continue business and such, they might not be able to handle the sudden 100 basis point increment. And because of this sudden 100 basis point increment, this could easily cause a recession. Okay, that's why I'm looking at it from the Federal Reserve point of view. So I do think that their resolve to solve inflation is definitely there. But it's true. I do understand that, of course, a few of the participants do think that the Federal Reserve might be a little bit too hawkish, too dovish at the moment. Okay, and in order for them to achieve the 2% longer run objective for inflation, which I think this is something that we have always talked about in general as a whole world, actually, that inflation should always be about 2%. Whenever someone is doing a budgeting calculation for, or investment calculation, we always take into account of a 2% inflation. Of course, right now, it's not really considered as a normal time. We just had a pandemic. We had a semi-recession. Times are tough. Okay, so this is definitely not one of the normal longer run, normal run kind of like expectation that we have for inflation at the moment. Expediting the removal of a policy accommodation will reduce this risk while also leaving the committee well positioned to adjust the stance of policy if geopolitical and other developments led to a more rapid dissipation of demand pressures than expected. All right, so what they're saying here is that, for example, like the example that I gave, okay, if I were to just increase a 100 basis point increment tomorrow, okay, and if we have a sudden recession that actually hit, just drop your interest rate back to 0. That's what they're trying to say. So because, if you actually increase the speed of how you remove your policy accommodation by increasing your basis rate hike for your interest rate, okay, one thing is that because if this were to happen, the Federal Reserve basically have a lot of power to just, we'll just look at the market. If the market can handle this sudden 100 basis point increment, they can. Okay, let's increase another 25 basis point in the 2004 version of us doing every 7 weeks of 25 basis point, and we'll see again. Okay, and if let's just say having a 100 basis point increment tank the market, everyone's going through a recession phase or a pseudo recession phase. Oh no, what are we going to do? Federal Reserve, you will have to go back to what we actually did in the March of 2020, drop everything back to 0%, and we'll restart it again. So I think that's kind of like what the participants, the other participants, are actually thinking that the Federal Reserve should be doing, which I don't think that's completely wrong either. I do think that there are some perks of them actually doing that. All right, and then next up, they're talking about the whole geopolitical and other developments led to a more rapid dissipation of demand pressures than expectation. Okay, so they're saying that, rapid dissipation from geopolitical worries and such is because, if you have a lot of policy accommodation during war period of time, okay, geopolitical tensions, there's gonna be a very quick dissipation. Okay, as compared to a very quick dissipation of demand, because people are going to be worried about a whole geopolitical tension happening. People are worried that if Russia and Ukraine is going to fight, there's a good chance that I do not need to borrow as much money to continue to expand my business and such. But yeah, so I do think that this was quite an informative FOMC minutes. But same thing, I don't think that this should have tanked the market. Of course, for myself, I am currently playing the market in two very different spectrum. One for the market to really do really well, and one for the market to do slightly worse. Okay, I do understand that the market is going to be going through a very sideways trading market. We're just gonna be doing this, and it's gonna be trending downwards, and that's kind of my concern. Okay, so hopefully, if that were to be the case, I'm fine with that as well, because I kind of already predicted that to be the case. 2022 is going to be a very hard year for the stocks market to really recover, and I don't think that that's going to be that big of an issue. Of course, hopefully we don't see a recession, and of course we do hear a lot about Morgan Stanley, we hear about JP Morgan, all of them, they're talking about how there is a possibility that a recession is going to be hitting in 2023. Okay, I'll be talking more about that in the Saturday video when I explain about the whole 10-2 inversion happening and such. Or you can just search it on a lot of other platforms as well. I'm pretty sure a lot of people are talking about it. But anyway, that's all I have for this video. I'm sorry for it for being so long. But anyway, thank you so much for watching, and I'll see you guys tomorrow.